Good morning, everybody. Good afternoon, good evening, and welcome to our important presentation today. We do have a very important guest who I'll be introducing shortly, but for now, just want to make sure everybody's on, and we'll move through the next slide. I believe this is the beginning. Everybody hear me? Good, perfect. Okay, so we're going to be talking about resilient investing for turbulent times. That is the theme, and you'll be seeing it come throughout. We are indeed in turbulent times, as everybody is well aware. And of course, the question is, how does our investment strategy adapt and respond to the turbulent times? So here is the basis on which we built RVW. We have always viewed every RVW portfolio as a sailboat navigating the ocean, and we've always viewed ourselves as designers and sailors of sailboats. And the core is, first of all, building a solid hull, which means making sure that the financial plan is correct, that it's designed to harmonize the risk tolerance, the income needs, the need for growth and safety of every individual client. We always want to make sure that we have which means taxes, costs, and so on. We want to make sure that the tailwinds are optimized, which means seeking to participate in major economic trends in a dynamic and responsive and real-time manner, and using evidence-based portfolio management style. In other words, we try to minimize the judgment areas and focus on the science areas, on the spectrum of science on the one side and art or forecasting or predicting on the other. We tend way more towards the science and sit on the shoulders of giants in that area on whom we rely for tons of data. I will point out to you that the three of us from RVW who will be speaking today are all CPAs, as well as being registered investment advisors, etc., and many other qualifications and certificates. But our orientation is always that of an accountant, always data-based, always looking at facts. We live in the present. Most people in our business either live in the past, looking at what did well yesterday, the funds that did well, the managers that did well yesterday, or looking towards the future to see what the Wall Street analysts and forecasters are predicting. And of course, we know that neither of those really works. The analysts are always wrong with overwhelming likelihood, and the forecasters have such a poor record. And of course, we know that those funds that did well yesterday are usually the ones that do worst going forward because of what's called reversion to the mean and other technical issues. And so we are in the present. We live in the present, and the portfolios we design are specifically designed to respond in the maximum way that we can to what is currently going on, and we respond in real time. Moving forward, it's my great pleasure to welcome and introduce to you our guest for this morning. I'm hoping for the slide to move forward, please. Thank you. Our guest for this morning, Conor OBrien. The reason that we're doing this, and it's very unusual for us to do this, but we figured that it was the right time to introduce Conor, not only because of the fund that we plan to introduce into our portfolios generally over the coming period, but also because it's the kind of fund that represents the way we think about things. It is a dynamic fund, adjusts in real time to changing situations, stuck in the present to the maximum extent rather than focusing on what did well, and will, because of its methodology, as you will find out, continue to adapt as society moves forward to be most representative of the most important companies. Conor's bio is attached. He's the CEO and president of OShares, which is a very significant and important ETF provider. We like ETFs because of how they're structured, their tax efficiency, their cost efficiency, and the fact that they can be traded throughout the day, and they don't provide, in general, what's called phantom income. In other words, it's a very tax-effective way to go, and that's very important to us. And everything we do is seeking to minimize taxes during the period of holding. Conor OBrien has a terrific background. You can see it, and I'm not going to read slides to you. That's not my style of presentation. He can certainly speak for himself And it is with much pleasure and honor that I welcome Conor O'Brien to our forum. And I'm sure we're going to be extremely impressed by him and the fund that he's going to be talking about. So Conor, thank you, and over to you.
Great, thank you very much, Selwyn. Let's do a quick sound check. Can you hear me fine?
Yes.
Great, great. Well, good morning to everyone. Yeah, obviously we're all living through an unusual time, and we believe it really is going to be a pivot point in how the socioeconomic evolvement of the economy goes for the next multiple years. And you know, as an ETF company, what we provide are ETFs that are different, not the generic ETFs that just own everything in market cap weight. We do extensive research-driven investment analysis first to determine how do we create the index that's going to own what we want our ETFs to own, and then have the ETFs reflect those. And as Selwyn mentioned, ETFs are extraordinarily tax effective because they essentially do not push out income to the investor every single year. They, generally speaking, avoid doing that. So it's a great investment structure. And with the evolution of ETFs, firms like ours have been able to create useful ETFs that are different than generic. And so just wanted to clarify that for people who think that ETFs, as they historically did, simply track the generic index. It's now permitted to have them track specific indices created for specific objectives. So Selwyn, what we did with OGIG, that's the ticker of the O-Shares Global Internet Giants ETFs, is we wanted to address the question that many people are asking. They're basically asking, hey, what happened to the tech sector? The tech sector used to be a sector with strong growth companies, large companies with strong growth. But the world has evolved, and many people like to think that technology includes Amazon and Google and Facebook and these other mega cap high growth companies, but it doesn't. Those companies were never in the tech sector, or they got pulled out of the tech sector and put into other categories, along with consumer discretionaries or communication services. So now you find companies like Google are blended in with AT&T and Verizon. It's not a category that really has characteristics that would typically be sought after by an investor who wanted to own what is becoming a dominant characteristic of the economy. So what did? We developed OGIG in order to own all of the large cap stocks that met the criteria of being e-commerce and internet services. They were tech-driven companies. And not just all of them, but actually those that had strong financial metrics for good balance sheets, good profitability, strong revenue growth. And so the net result is you look at OGIG and its stocks in the portfolio of the ETF OGIG, you see a revenue growth rate of 38%, trailing 12 months revenue growth rate. You look at the tech sector stocks and you see a revenue growth rate that is single digit. It's actually lower than the S&P 500. And that's because it owns a bunch of nice stocks like IBM and everything else that have been around for decades or centuries. They're nice, but they're very, very slow growth. So the tech-driven growth that you find in companies like Facebook and Amazon and Google and many, many others are found in OGIG. And for the most part, you don't find them in the traditional or generic sectors. And we talked to Selwyn a little bit about this to share ideas on the economy and what's going on. And really, these tech-driven companies will own the future. And technology is no longer just kind of a subcategory out there on the side. It's at the core of every business that is likely to be successful over the next several years. And the companies that ignore the need to use technology probably get left behind. Just look at what we're doing today. We're using Zoom. Look at how companies are conducting internal meetings and external meetings. They're using technology, whether it be Zoom or others. You look at some of the logos that we just had on the board there. You could go back to those. You got Zoom, you got DocuSign, Atlassian, RingCentral. Some of these companies are business to consumer, some are business to business, and they're all just part of the mosaic of technology companies that many businesses need to use to deliver their services in a much more cost-effective and consumer-friendly way. So it's not just Amazon and Google and Facebook. All these other companies that are, let's call it mid-sized, multi-billion-dollar companies growing even faster than the Google, Facebook, Amazons. And so this ecosystem of companies is at the core or the foundation of so many different businesses. Just think about how yourselves, you're going to go do your food shopping in the future. Probably, many of you are probably going to do less visits to the store and more online shopping. Think about how companies are going to be delivering their services. They're going to use technology, even when it comes to food delivery, they're going to use technology to have the pick, pack, ship, and somebody drive and drop to your door. Ring Central's a company that basically is essentially the security service provider that makes it really easy for you at your door to receive shipments, even if you're not home. So all these technologies enabling faster evolution and change and efficiency. So now into this coronavirus. Shock to the system, market sells off over 30%. What happens? Everybody stays home, works from home, and habits start to change. Think of your home entertainment. Look at Netflix, look at Disney, look at all the online entertainment. They have grown massively, massively. So people are going to be staying at home, shopping at home, working from home, getting more entertainment from home. There's going to be less trips to the ballpark, unfortunately, less trips to the basketball games and football games, and much more esports. All of these get captured by OHG because of the way that index is designed. And so, Selwyn, what I think one of the many things where we see eye to eye is that the technology is not really just a fringe sector anymore. It really is at the core of the foundation of how so many businesses in so many different sectors will be proceeding and how they'll be succeeding and growing. And the companies in OHG are designed to be the ones that have that quality characteristic on balance sheet profitability and the strength of revenue growth. So I'd like to maybe just engage with a little bit of Q&A with you, Selwyn, just on some of these themes. Do you want to talk business to business companies? You want to talk business to consumer? What are some of the themes that you'd like to just pick on here?
Well, I like all of the themes, but if you just go back to the slide over there, the one we just looked at, which is, working at home, just go back one more slide there to the working at home. There you go. Zoom, DocuSign, Ring Central. We, a year ago or so, didn't use any of these. I will tell you today, RVW uses Ring Central as our phone system. We don't, not a day goes by that we don't use DocuSign or Zoom. And what's very interesting about this is when we started using Zoom about a year ago, roughly, it was really designed for our out of Los Angeles clients who, needed to see us. And there was a certain level of discomfort. I will tell you, even before the coronavirus arrived, maybe 3 or 4 months ago, we already noticed a change. That our clients were saying to us, I don't want to come in from the San Fernando Valley or from the South Bay or from Palm Springs to meet with you guys. Let's have a Zoom. And so just chiming in a little bit over there, we've seen this, in our office has been transformed over the last year. And just to reinforce what you said, Connor, the reason we're focusing on technology in this presentation is not because we view technology as a sector anymore. That's what I think the coronavirus has accelerated and changed. In other words, most analysts, most brokers, most wealth managers look at technology as a sector, like we have resources and oil and industrials and manufacturing and healthcare. So the thought was technology was one of those sectors. Our position is that what has been accelerated through this process is that technology is no longer a sector, but it's actually the infrastructure for every other sector. And therefore, we're not overweighting a sector. We're actually focusing on where we believe the future is, and the future is here. So, I'd love you to keep going. These slides are terrific. I love your themes of work at home and stay at home and play at home and et cetera, which are all happening. And it's obvious that many of the things which are happening right now in our lives, the trends, the patterns, will continue. And we want to participate in the profits made by those. So I'll hand it back to you to run through some of the themes in your holdings, and then to go to the dynamic nature of the allocation and selection process, which is a key part of why we are planning to include this.
Great, yes. So this slide shows one name that everybody knows, Amazon, and another one that almost everyone knows, Netflix. Let's look at Amazon compared to Shopify. Shopify is now a 60 billion plus company many people have never heard of. It allows an individual person to create an e-commerce business that has everything. It's going to have the website and the digital marketing and the electronic online purchasing processing, and it'll have the fulfillment support systems, everything. You could just get off this call in a half an hour whenever we wind up and decide, you know what, I'm going to create Joe or Jill's coffee, and they will actually enable you to activate your e-commerce business so quickly, and they're selling you essentially software as a service, fulfillment as a service, etc. You can Amazon yourself. So Shopify is growing incredibly quickly, something like 40% revenue growth, and it's essentially a software company that enables e-commerce of the type I described. Very powerful solution and growth rate. And so many companies and small businesses are going to be using this kind of service, whether it's Shopify or others, in order to modernize their business. Etsy is one that many people maybe know as a business to consumer for small business. It's a little bit more, call it hobby and fun, but they've got an incredible array of really interesting products on it that you just don't find on Amazon. So it's differentiated there. Netflix I'll touch on briefly. Everyone knows it, but now think of it. You got to have Netflix and Disney Plus and Hulu and I don't know how many others if you want to have access to all the entertainment. And guess what? Lots of us are going to say, we're going to cave and say, all right, I'm going to subscribe to another one and another one. And oh, I wanted to watch that movie, so I need this fourth one. So we're just all going to spend more money online for entertainment, less time going to the cinemas. No one's rushing out to go to the cinema next week or next month, even if they open up. You're going to stay home and watch Hulu or Netflix or Disney Plus. And that's where the revenue is going to go. It's not going to go to the popcorn and the cinema at AMC. So think about how your habits have changed, your revenue spending, your money spending changes, which is revenue for all these companies. We are all part of driving the revenue growth of these kinds of companies. If we go to the next slide, see a slightly different theme here. And so we just want to touch on, these are entertainment companies. Tencent actually is one of the biggest digital entertainment companies in the world. It's not just in Asia, it's everywhere. And there are many others catching up as well, whether it's Activision, Ubisoft, and others. There are more and more, and the younger the people are, the more they're using online entertainment, games of all sorts. And it's just enormous. It's huge. It's much bigger than Netflix. This category is much bigger than all of the online entertainment, movies, etc., that we all spend money to watch. And it's probably something like 3 times the size. The entertainment, online entertainment business, when we looked at the data, it's like, holy cow, that is enormous compared to the just regular digital entertainment that we all think of when we think of Netflix. So I just wanted to call everyone's attention to that. These are global businesses with global games and a global customer base, and they just keep selling subscriptions and doing extremely well. This chart here just shows you a number of names, logos that you know, and the revenue growth rates down that right-hand column. And what I can tell you that really is the dynamic investment method of this fund is that revenue growth drives the size of the allocation to each of the stocks that are in the portfolio. And I'm going to pick on one in there, Baidu. Everyone used to think Baidu was the Google of China. Well, guess what? It's not. They somehow failed to maintain a revenue growth rate, and it's just been downgraded to be a microscopic position in OGIG. The companies with the strong revenue growth rate upgraded to greater allocations in OGIG. And this is all for a research-driven reason, not just common sense. If you have 2 businesses that are very similar, one with revenue growth and one without, you probably prefer the one with revenue growth. I think what's happening, the customers are saying, hey, that's the one I want to buy. Whether it's entertainment or e-commerce goods or anything else. The customers are deciding that that's the one that's got the better services. And so that is an important metric of quality. And that is really a hallmark of what we do. We try to identify the financial metrics that cause stocks to perform well, that helps identify the stocks that are going to perform well. And in these categories, revenue growth is so important. So you see on this list here, you see a lot of stocks, and what I can tell you is the characteristic that drives so much is revenue growth, and whether they're in the portfolio at all and the allocation they get in the portfolio. A little bit more on the dynamic allocation process, I'll tell you, it starts with this, thousands of large cap stocks, the entire universe of global large cap stocks, and then exclude all of them except those that are in the 7 subsectors that correspond to e-commerce and to internet services, for entertainment, for business to business, business to consumer. And then of those that make it into that set, exclude any that have a weak balance sheet, that don't have the cash and equivalents for any burn rate, or have weak profitability at the gross margin level. And then of those that make it in, score and select them based on strength of revenue growth. So we end up with about, right now, 70 stocks, 70 companies that are in OGIG. They're multi-billion market cap each, from the mega caps to many others that are emerging mega caps and growing even faster. And every 3 months, there's a portfolio rebalancing. Every 6 months, there's an entire portfolio reconstitution. One interesting thing I'll tell you, it does not include Uber. It does not include Lyft. Those companies are not e-commerce or technology or internet services business. They're actually transportation services companies. And so happy to tell you that they are not in there. I'll tell you an example of a company that is in there that's not a great company right now. Booking. They have all of the hotel and travel bookings, but it is a very small allocation, very small, because the dynamic allocation works. As the revenue growth rate slowed, it got downgraded to a very small position. And so you might see ETFs that do not have a dynamic allocation process, and they get stuck with large stale stocks, large stale positions. OGIG designed, of course, the way I've described, to avoid that. Another thing interesting about OGIG with IPOs, people say, well, did you get into that hot IPO? Well, guess what? Half of the IPOs, or some of the IPOs are hot and everyone talks about them. Many are not. And the research showed us that rushing into an IPO is a risky mistake. So we do not allow IPOs into the portfolio until they've seasoned. So they have to have been trading for over 90 days. And you get much more stability, less risk that way. One other thing, you'll see that the really big stocks get capped, maxed. Nothing can be greater than 6%. And every 3 months, anything that grew above 6 gets trimmed. So that's a little bit about the dynamic allocation process, Selwyn, that I know you know all about, but I'm happy to have had a chance to explain it to your audience.
No, thank you. That is really great. Thank you, Connor. It's been an honor to have you with us. We're going to continue with the rest of our program, but I just wanted to make sure everybody got the fact that this is a rules-based system. The people at OGIG or at OShares don't sit around every week wondering whether Amazon's going up, down, or sideways. In fact, this is a rules-based scientific approach to a dynamic selection process, and that's the kind of world we like. As you know, as I've said, we focus more on rules and on binary system than on people's judgments and forecasts and predictions. So you fit right into that. And we will be making we don't make huge moves at RVW. We call it tilting the sales, adjusting the sales. And this will be one of the sale adjustments that we'll be making for most of our portfolios. Thank you very much for joining us. We're honored to have had you.
Thank you very much.
Thanks.
Thank you, Connor. Can everyone hear me okay?
Yes, we can hear you great.
Okay, great. All right, so here are the 3 most frequently asked questions, and I'll read them over so everyone's aware. One of the questions we get is, why don't we just buy the S&P 500 index? And we'll cover that in the next subsequent slides. And another question we've been getting asked a lot is, what explains the market's rapid recovery in April? As everyone might know, in April, after we saw very, very quick declines in March, in fact, we saw the quickest bear market ever. We also saw the shortest bear market ever. So it was very important to stay invested, and we wanted to cover what what occurred to have the market recover very quickly? And then last, why don't we just pick the stocks and time the markets so that we get in at the bottom and ride the wave up? Now, to answer the first question, we have the next slide, and it's one of our favorite slides. How you could see this chart is looking at different factors based on the indexing companies. Connor mentioned that there are different ways to group companies. And as you can see in the first three columns, let's see S&P 500, 400, and 600. S&P is simply a company that groups different companies, and the one that you might know the best is S&P 500. And that simply means actually the 500 largest companies in the United States. Now, S&P 400 happens to be the mid-sized companies in the US, and S&P 600 happens to be the 600 small companies in the US. Now, the last two columns are international. One's looking at emerging markets. Think Brazil, India, Russia, China as some of the bigger emerging market countries. And then you have MSCI EAFE, which just means developed countries. Now, what's really striking here is if you look at the total returns, you are seeing annualized returns every row, how it happened in year 2000. So as you can see, large caps are down 9% in year 2000. And if you're looking at other categories, mid caps, small caps have performed well in the US, whereas emerging market countries and also developed international countries are down. But if you're looking at the total return, S&P 500, again, the largest US companies, were down after 10 years of investing. They were, in fact, down about 9%. Now, if you're looking at mid-size and also small-size companies in the US, they were up about 85% during that same time span. And then, in fact, in emerging markets, it was up well over 160%. So the reason why we mentioned this is that was going back to the first question, why don't we just invest in the S&P 500 companies? We could see that if you are concentrated in a particular grouping of companies, it doesn't matter what it is, whether it's large-size companies, small-size companies, emerging markets, you might be in a period where after 10 years of investing, being down. So we don't want our clients to be in that situation. What we do is really manage core nest egg. So we thought this illustrates that particular point of the first question. Now, the next slide really looks at the concentration risk. Now, again, if we're really just focusing on the S&P 500, how does it look? As you could see right now, the 2% of the allocation within the S&P 500 is about 26% of the weighting in the S&P 500 index. Now, said it differently, Apple, Microsoft, Amazon, Google, and Facebook, all the companies you might know, are collectively worth about $5 trillion. Well, the whole S&P 500 has valuation of about $27 trillion. So as you could see, just 5 companies out of the 500 in the S&P 500 nearly account for about 20% of the market value. So as you could see, you could really see the concentration risk within the large groupings of companies. Now, if you're looking at the next slide, the S&P 500 Tech Index, you could really see how this breaks out. Microsoft, Apple actually account for well over 40% of the tech portion of the S&P 500 index. And then if you're seeing on the bottom right side, it says the top total 10 companies have about 68% of the weighting. Again, this just illustrates concentration risk. And as Connor mentioned before, when you really weight companies by revenue and looking at other fundamental ways to weight the companies, you won't run into a situation where, I'm not sure if anyone remembers this, but back in 2002, Cisco, the high-speed networking equipment maker, was the most valuable company back in that time. They were worth well over $500 billion back in year 2002. Still, they have yet to recover even half of that amount almost 20 years later. So again, that really illustrates concentration risk at the tech level. Now, if we're looking at the next slide, now Selwyn mentioned also, we really look at rules-based methodology. And we wanted to target innovation by reviewing the revenue lines at a much deeper level than broad definitions that are in the current marketplace. So what you see here is with Apple, you have the consumer line and also technology line. And you could really see how, based on all the various rules-based methodology we analyzed, how revenue is broken down. And actually, now that you saw an example of the Apple, it's really important to see how technology is defined. For example, Visa and MasterCard are great examples. Are these financial firms or credit service providers? Could it be a technology company? Now, if you're asking what the answer is actually all of the above. It really doesn't make sense, but we actually mentioned S&P indexing company. We mentioned S&P 500, 400, and 600. S&P fund provider or the indexing provider consider them as tech, whereas another really well-known indexing company, Russell, they consider them as financial. So again, there's no real right or wrong way to define a particular company, but in the case of Visa and MasterCard, it really is a good example of looking at it from a tech lens or a financial lens, depending on how you view them. This is why we're working with also a company called FactSet to target US listed technologies in 100% rules-based methodology, meaning, again, there's not really any human discretion within the stock selection. Now, within the FactSet, it breaks down the revenue in a very detailed manner to group the most similar companies together. And usually clients, love looking at specific examples. So when you're looking at Facebook, generally speaking, most people think of it as a tech company. But when we really broke down the revenue lines, kind of like what we're seeing here, it should be really defined as looking at social networking at the most granular level. This kind of classification industry at a detailed level allows only the most similar companies to be grouped together. And once they're grouped together, we can calculate the fundamentals as a group to gauge their attractiveness, valuation. Connor mentioned, again, looking at it from a revenue perspective. And looking at it from a revenue perspective is a really important point because that brings in the momentum component. Now, when we analyze momentum factor, the one way to look at it is from a sales perspective. After all, the ability for a company to make revenue is a critical factor in evaluating a price of a stock. Now, sum it all together, here are some of the examples of how companies are included or excluded from this particular index. Zoom was added last year because it was classified as an industry called communication productivity software. And the company had the highest momentum score, putting it in the top quartile of its particular sector, so Zoom was included last year. So again, very rules-based, looking at revenue, and companies get included. Now, what was excluded? Groupon was classified in an industry called city guides and electronic media sites. Now, as you could see with Groupon, it's had a lot of competition, and one objective way of evaluating Groupon was looking at sales momentum, and sales continue to decline. And Groupon was actually removed last year. And if you're looking at year-to-date performance, these kind of objective metrics were important because Zoom continued to climb with additional revenue coming in, and Groupon continued to decline with revenue continuing to suffer. So we thought these kind of rules-based systems, along with these kind of examples, will be very illustrative for you to get an understanding how certain companies are getting included and excluded. So that sums up that component. Thank you.
The second question, Stefan answered why we don't just pick the S&P 500 index and some of the flaws with its subjective construction and overweighting. I want to deal with the second question, which was what explains the rapid recovery in April? And we here need to review the emotional roller coaster that equity investors must be prepared for. And this educational process is core to our onboarding of new clients and reaffirming of the direction of equities for anyone who wants to invest in equities. And we go here, you start out with optimism, enthusiasm, exuberance, euphoria, and then it goes to anxiety, denial, fear, despair, panic. And this is the roller coaster that we all experienced in April. And it was really driven by emotion, fear, greed, And the next slide is more data-driven, but the same point, which is what we're looking here is the 2008 collapse of the markets, and that's and you'll see here that people are buying at the top and selling at the bottom. So the red line is the performance of the S&P during the collapse, and the green is whether people were buying and selling. And you can see up until the collapse, it's all green. People are buying, buying, buying. And then when it starts to go down, they're selling, selling, selling. And then when it recovers, they're buying, buying, buying. We as humans, as as a species, we tend to herd when things are good and flee when things are scary. And as an investor, it's just the wrong approach. And these are two of the reasons why April was just such a roller coaster. The statistic that Stefan cited was the fastest and shortest bear market in history. And you're seeing here that we are reacting to the news and the noise instead of sticking to a prudent plan that's developed, ahead of time. It's battening down the hatches in advance of the storm. And you'll see here this final news article with ETFs beloved by mom and pops bleed record cash during the epic rally. And it's like things are going great, but people are reacting in a sort of a delayed manner to what we're seeing on the ground. And Buffett, I think, says it best. Imagine a person out there, Mr. Market, is kind of a drunken psycho. Some days he gets very enthused, and some days he gets depressed. And you have to ignore this Mr. Market, manic depressive partner of yours, because in the short term, equity markets are a voting machine, but only in the long term will they be a weighing scale. And that's the key, is to understand that in the short term, the news and the noise, the emotion, the desire to pick the time is what's driving short-term movements. But in the long term, it's the profits of the underlying companies that will drive performance. And with that comment, I'll just add one more statistic, that the value of a given stock is determined by mathematically, Finance 101, the present value of all future earnings. And if you eliminate the next 12 months of earnings, it will decrease the value of the stock by only about 10%, or about 10%, I shouldn't qualify that. And so you can see that the one-year earnings on a stock has measurable but not terminal impact on the value of the stocks long term. And it's just important to remember when we're going through something that we know ultimately we'll get through. And the third question that we're getting most frequently is, why don't we pick stocks and time the markets? And this is somewhat obvious to all of our clients and our team that stock picking and market timing don't work, but there's a whole world of Wall Street of retail marketed investment strategies that pursues this idea of stock picking and market timing, trying to control one's environment. Again, deeply human, but it doesn't work in the area of stock markets, and it's totally unintuitive. Surely we can figure out when to get in and when to get out, but you can't, because it's only with the benefit of hindsight will we know if today was a good day or a bad day to buy. And here I've got statistics. The next slide will be international. This is the domestic, published by S&P, Standard & Poor's, measuring the success rate of investors who seek to stock pick and market time. It's called active management. And by the way, you'll see active management either in a portfolio directly, where an advisor's picking the stocks and you see the trade tickets come through, or in the construct of an actively managed mutual fund or hedge fund. But ultimately, it's the same endeavor, the idea of picking when to get in and when to get out. And I'll draw your attention to 5, 10, and 15 years. Let's just take 10 years. Over any 10-year period, reading across the top row, you'll see that large cap managers have an 85% chance of failing to beat their own index. Mid cap, 88, 85 for small, and all 84. And I don't have the international, but the international is very, very similar statistics. So you cannot pick a time, you cannot pick a stock. There was the old adage, buy the blue chips and leave them in the top drawer for the grandkids, but I want to show you how that would have worked. If in 1980, my folks would have bought share certificates and put them in the top drawer They would have bought IBM, AT&T, Exxon, Standard, and so on, the ones in the left. These are the top 10 companies in 1980. And you'll notice that there's not a single company in that top 10 ranking that's in the top 10 ranking today. Based on what Connor was talking about, and Stefan and my father, and here it's quite obvious from the empirical data, one needs a system, an objective system, a dynamic system to determine what to hold and in what proportion. And that's what we use the ETF structure for, is the system of dynamically measuring what to hold and in what proportion, because you cannot just buy the blue chips and put them in the top drawer for the next generation. Dad, with that, I'm going to turn it back to you.
Good. Yeah, okay. So just following on from John's point, what is the market telling us? Basically, what the market's telling us is that over the next period, there will be a recovery. The market is telling us, and I'm not sure why I don't have my image up, but you know what I look like, so that's fine. What the market's telling us basically is based on John's idea, which we totally believe, and he expressed it well, that the only about 10% of market price or so is reflected in expectations over the next year or so. And 90% of market price is determined by market expectations for what will happen after that. And so the market is saying that we're going to get through this, and we're going to get through this in about 12 to 18 months. What is going to happen, though, is what is the recovery going to look like? And the letters of the alphabet, you know, there are people who talk about a U-shape, a V-shape, a Y-shaped recovery. We think it's going to be the Nike swoosh, or as I was recently corrected, it's called the Nike swoosh. And you all know what that looks like. It's a sharp down movement and then a very gradual movement back up. And we think that will happen. The market will come back. We're quite certain we will get through this. This is not a medical presentation, but there are 80 companies actively involved in researching vaccines currently. And there is a race on to fast track this. And many people believe now that within the next 12 to 18 months, there will be a vaccine available. There's some very exciting developments in this area, but that's not anything we need to express an opinion. The market speaks loudly and we pay attention. Let's look at what we think the drivers will be of the recovery. In other words, after the sharp downturn, what are the drivers of the recovery going to look like? And here they are, and they're going to be very powerful. Firstly, the fourth industrial revolution. And I will get back to that, but just to recap, the first industrial revolution was the steam engine that radically changed the entire economy. Every aspect was changed by steam engine, transportation, manufacturing, every aspect. Then we came to the second industrial revolution, which was electricity, which did the same thing about 100 years ago. The third industrial revolution was the invention of the silicone chip. And the fourth industrial revolution we will get to, but it is in process. And the COVID virus has simply accelerated the process of the fourth industrial revolution. The second driver, onshoring. You would have to not have read any news at all over the next period to miss the fact that there will be massive onshoring. I don't believe that ever again will the United States allow foreign people, foreign countries, foreign governments to control critical supply lines of the United States. Ventilators, machines, masks, antibiotics, etc. We are going to be building a massive onshoring. It has been stated, it is obvious, and it will be a great shot in the arm for the United States. Thirdly, after every downturn, there's always a rebuilding of inventories, because during the downturn, the manufacturing and supply lines cut back because demand cuts back, and there is a pent-up demand for all kinds of things: housing, white goods, cars, dental services. Just think about it. So many things that are postponed during bad times that then get accelerated in the post period. And finally, the ongoing benefits from the reductions of corporate taxes and the tariff wars. And let's just take a look at a few of these in great detail. The next slide shows you, and this is a very powerful slide, For decades, the United States had the highest corporate tax rate of all of our trading partners. Take a look on the left there. We had a 40% average corporate tax rate, federal and state. After the tax changes made over the last several years, we're now stuck smack in the middle at about 27%. Let me tell it to you as simply as I can. When you have a corporate tax rate of 40%, and your competitive economies have a tax rate that's a third less than yours or half of yours, what you're really saying to companies is go and do business elsewhere because the tax rate is less. And so what we said to automobile manufacturers was, you can build in the United States or you can build your cars in Canada. And Canada, by the way, has a marginal tax rate of 26.5%. So you've got about a third off there. So what do you think people did? Car manufacturers said, well, let's go to Canada. And by the way, they also went to Mexico. And so Canada and Mexico have massive automobile industries, which we spawned, which we encouraged. And that is over. We now have a competitive tax rate, and the onshoring process that was triggered by this, which started before Corona, we believe will continue, and it's basically pretty much an unstoppable trend. Taxes are a huge factor in making decisions about locating businesses, and this was one of the tailwinds that was driving the economy before, and will certainly resume. Let's take a look at the other side of the coin. Not only did we have the highest tax rates, but we also had the lowest tariffs. Once again, if you say to European companies, you can send us your cars, and we'll tariff you at some low percentage, and when we send you our cars, they'll be tariffed at a higher percentage. Then you know what's going to happen. And so we had the lowest tariffs, which means we encourage people to export to us, and many of our trading partners had very high tariffs, which discourages people from buying American goods. The whole tariff war is entirely about this chart. So these are powerful forces that, together with the others that I mentioned to you, will be tailwinds that will move things forward. Looking back at what RVW does, our basic focus is on long-term equity ownership. We seek, by the way, you should know, to distinguish risk from volatility. Now, most people think equities are risky, and we don't. Risk we define as the possibility of permanently losing capital. We have 200 years of history to show that the model that we follow, the style of investing that we espouse, has overcome every single economic and political problem over 200 years in the fullness of time. In other words, the only thing that one needs is the ability to sit buckled in during the turbulence, and the rewards have been generous. We believe there is no reason to think that shouldn't continue. And why do I say we seek to avoid risk and embrace volatility is because when you pick any individual company, and Jonathan made a very good and impassioned point about it, when you pick any company, basically you are subject to the risks of that company itself. We call that company-specific risk. And you all know those kind of companies. BP had an oil crisis. Volkswagen had a diesel gate. Boeing has had a huge series of catastrophes. Those are all company-specific risk that is manifest, not predictable, but can have permanent effect on valuation. We eliminate company risk by being broadly diversified. No company, and not even a small group of companies, can make a difference to our portfolio because we seek actively to eliminate company risk. That also means, by the way, that we also eliminate the huge upsides of picking the right companies. But we're willing to pay the price of not being the best performers, which we never will be in the short run, to be the best performers in the long run. And we do that by avoiding the huge mistakes of stock picking in something like what you saw. And the cycle of successful companies that have life cycles like human beings, that come into being, grow, evolve, mature, and then cease to be big. We want to avoid that stock picking. And so we do. Our typical portfolios have over 10,000 companies in them, fractional interests, so that company risk is basically eliminated. We then have sector risk. Once again, we include every sector. And so if one sector goes down, as the oil and energy sector has, it hardly makes a dent, because while oil and energy have gone down and financials have done badly over the last period, technology and many other sectors have done really, really well. And so we eliminate sector risk by diversification, which leaves us with market volatility. And market volatility has worked extremely well for people over time, not all the time. And knowing the distinction between over time and all the time is the hallmark of smart investors. And so we broadly diversified globally. We seek to remove risk, and everything we do is evidence-based. We don't go into or out of, we tend to tilt towards the factors that have historically, and we believe will continue to provide enhanced returns. And the dynamic equity selection process makes sure that we have a Darwinian model, always overweighted to the best performers and underweighted to the worst. It's just, I think, a good idea just to recap that as we move through the rest of the presentation. As you heard from Connor, we don't believe technology is a sector. And I want to just dig into that a little bit more, because technology is it's actually one of the core infrastructures going forward. We briefly covered the industrial revolutions, and I want to talk about the fourth industrial revolution, because it will impact every aspect of the economy and of life itself. Basically, it takes the previous three and moves them to the next level. You all know about the impact of artificial intelligence, RFID chips, which will be on everything, 5G, and so on. And all of these companies that you see are all part of the core infrastructure. As we saw with OGIG, technology impacts how you live at home, how you work at home, how you play at home, how you shop at home, etc. And those are mega trends in place that are not going to be reversed. And we seek to participate in that. That is one of the sail adjustments that we're making to the sailboat. Now, one of the other changes, and we'll be making several tilts. One of the others that we're going to be doing is we're going to be moving more towards larger and stronger companies than we have before, because we believe that in the carnage, in the destruction that will take place in this mode, in this depression, recession that we're in, the strong companies and the companies that have strong balance sheets, and don't forget, we focus on financial statements. We live in the world of financial statements. Larger, stronger companies, we believe, will profit from the carnage and will expand their footprint. And here you see a recent headline from Bloomberg, May 3rd, which talks about exactly this. The big keep getting bigger in the pandemic rearranged economy. We believe this has always happened. It's what the great economist Joseph Schumpeter called creative destructionism, the great capitalist machine that destroys the weak and enhances the strong. And we want to be with the strong. And so we will be tilting more towards very strong balance sheets, strong companies in the coming period, because there is much turbulence and much volatility ahead of us, and much of it is unpredictable. But what we know is the big and strong will be best placed to take advantage of whatever lies ahead.
Back to Stefan for the dividend yielding section.
Thank you, Selwyn. So as Selwyn mentioned, just we need to continue to adjust the sales, and dividend-paying stocks is one of the ways that we continue to adjust the sales. And given where the interest rates are today, where the 10-year Treasury bond, when I checked this morning, was paying about 0.66%, investors have a need to seek for alternative sources of income. And the current environment is far from the environment like it was in 1970s or 1980s, where putting some money into a CD at a bank paid 5 or 10% of interest income. This is why dividend-paying stocks are more and more becoming bond alternatives, as illustrated on this particular slide, for those seeking retirement income. And dividends in the long term are remarkably stable, and our rules-based methodology reviews for companies that have the ability to continue to increase dividends in the future. Now, next slide is one of the great slides from Warren Buffett. And what this shows is that the dividends alone from Coca-Cola, from his initial investment in the company, it covers the initial investment every 2 years because of the 62% yield. From his initial investment, 62% gets paid every year in the form of dividends. And again, Coca-Cola is one of those companies, since its inception, had the ability to continue to pay dividends because of their strong balance sheet. Now, another way to look at dividends, if you're looking at the next slide, is dividends increased 4 times over this period since about year 2000. So all we had to do is endure some of the bumps along the way, including 2008 and the recent drawdown, because dividends are, again, remarkably stable, and companies have the ability to continue paying them and then increasing them. So dividends have to be a critical portion of the portfolio. And back to you, John. Thank you.
Just wanted to emphasize again that it's becoming increasingly difficult to pick the winners in the tech world, and news and noise and data hacks and data breaches and new entrants make the system so rapidly changing that you really need a system in order to select the winners and maintain a holdings portfolio. With that, back to you, Dad, onto OG.
Okay, thanks. Just a quickie. I'd like to wrap this up. I think we've made all the key points. Just for those who are concerned that we may be in a tech bubble, we wanted to give you this slide to show you what a tech bubble looks like. If you look at the period of 2000, 2001, look at that blue line and see how overpriced S&P technology was compared with the broad market. If you look to the right to see where we are now, there is no overpricing. The tech companies we're looking at are large, they have revenues, they have profits, they have space in the market, and you're not just dealing with a PowerPoint presentation and a business plan and hope, but we actually have real numbers. And so those who are concerned about a tech bubble, don't be concerned. We are not in one now by all objective standards. I thought it'd be kind of nice to look at the OHG performance, by the way. Take a look at that. This is 2020, looking at that compared to the broad market. You can see it just did spectacularly well. And we think for all the right reasons, not because of stock picking or market timing, but because of a strategic asset allocation to the infrastructure.
With that, we're going to wrap up the meeting. So thank you, everyone, for joining us. Any questions or follow-up can be addressed to our office, JG, SG, or SS, all at rvwwealth.com. That's our first initial, last initial at rvwwealth.com. And we welcome the opportunity to speak with you, engage with you more deeply, answer more follow-up questions. Thank you, Connor O'Brien. I appreciate your
if I could just chime in, you will see some trades coming through as we begin to implement this throughout our portfolios on an as needed basis, as appropriate basis. Thank you all for joining us. There is a replay. If you would like it, you can request it by email and we'll send you a link. Thank you so much.